You were told buying a house is the smartest financial move you will ever make. You were told renters throw money away. You were told homeownership builds wealth while renting builds nothing. You were told this is how the middle class secures its future. You were told wrong, the house you buy will not make you rich. It will make someone else rich, and you will spend 30 years proving it. This is not about whether you should own a home. This is about why you were taught to believe ownership equals wealth when the math has never supported that claim. The average American homeowner spends more on their house than they will ever extract from it. The return on residential real estate after maintenance, taxes, insurance, and interest averages below 3% annually. The stock market average is 10, yet you were never offered that comparison in a clean sentence. You were sold a story instead. The story works because it ties your identity to a structure. It makes you feel safer. It makes you feel successful. And while you feel those things, the financial system extracts 30 years of compounding interest from your future. Here is what they do not tell you. Homeownership is not an investment. It is a liability dressed as an asset. Every month you pay the bank. Every year you pay the state. Every decade you pay for repairs that return zero income. The house does not generate cash flow. It consumes it. And when you finally sell, the profit you think you made was eaten alive by inflation, transaction costs, and the opportunity cost of what that money could have done elsewhere. The average American moves every 13 years. That means most people never hold the property long enough to escape the front-loaded interest trap. They sell at a modest gain, buy another house, reset the interest clock, and repeat. This is not wealth building. This is a subscription service to debt. The system refined this trap over the last century. It did not invent it from nothing. It borrowed pieces from older mechanisms and fused them into a modern control structure. Start with company towns. In the early 1900s, coal and steel companies built entire communities around their mines and mills. Workers lived in company housing. They shopped at company stores. They were paid in company scrip that could only be spent within the system. The promise was security, a roof, a job, a future. The reality was control. You could not leave without losing everything. Your shelter was tied to your labor. If you quit, you were evicted. If you complained, you were replaced. The structure kept workers geographically and financially locked in place. They thought they were building stability. They were building dependence. Move forward to the post-war suburban boom. Between 1945 and 1960, the federal government subsidized massive suburban expansion through highway funding and mortgage insurance programs. The stated goal was to house returning soldiers. The actual mechanism was wealth transfer. Developers bought cheap farmland, built identical houses, and sold them with government-backed 30-year mortgages. Banks loved this model. It turned homeownership into a guaranteed annuity stream. The buyer thought they were entering the middle class. The bank knew they were entering a 3-decade payment contract with front-loaded interest. In the first 10 years of a traditional mortgage, 70% of your payment goes to interest. You are not building equity. You are paying rent to the bank with a different label. Then came the financialization wave of the 1980s and 90s. Mortgages stopped being agreements between you and a local bank. They became securities. Your debt was packaged, sliced, and sold to investors as mortgage-backed bonds. This changed the incentive structure completely. The bank no longer cared if you could afford the house long term. They cared that you qualified at signing so they could sell your loan upstream. The riskier the loan, the higher the yield for investors. This created the conditions for subprime lending, adjustable rate traps, and the cascading defaults that revealed the con. But even after the crash, the core mechanism stayed in place. Your mortgage is still a tradable asset. Your monthly payment still funds someone else's portfolio. The house is still the product. You are still the customer. These ancestors share 3 elements. They all promise security. They all locked people into long-term payment structures. And they all transferred wealth upward while making participants feel like they were climbing. The modern homeownership trap inherited all 3. It just added better branding. This brings us to stage 1. You are primed to believe renting is waste. Every financial guru, every family member, every social signal tells you that paying rent is throwing money away. But rent is the maximum you will pay for housing. A mortgage is the minimum. Rent includes maintenance, property taxes, insurance, and the cost of flexibility. A mortgage excludes all of that. The hidden costs of ownership are not optional. They are structural. The average homeowner spends 1 to 4% of the home's value every year on maintenance alone. That is before property taxes, which rise regardless of your income. That is before insurance, which increases with climate risk and inflation. That is before HOA fees, which function as private taxation with no democratic oversight. Add it all together and the average American homeowner spends 40 to 50% more per month than the sticker price of their mortgage. But you do not see that math until after you sign. Stage 1 works because the comparison is rigged. When someone tells you renting is waste, they are measuring your rent payment against zero. They are not measuring it against the total cost of ownership. The illusion is that your mortgage payment is building equity, while rent builds nothing. The reality is that only a fraction of your mortgage payment reduces the principal. The rest disappears into interest, taxes, and fees. For the first decade of a 30-year mortgage, you are barely touching the loan balance. You are paying the bank for the privilege of owing them money. Then comes stage 2. You are pushed into maximum affordability. Lenders do not calculate what you can afford. They calculate what you can survive. The standard affordability formula allows you to spend 28% of your gross income on housing. Gross means before taxes. That percentage does not include maintenance, utilities, or the financial buffer you need for emergencies. It assumes you will stretch. The system wants you at maximum leverage because maximum leverage produces maximum profit. A buyer who stretches into a $400,000 home generates more interest than a buyer who comfortably buys a $200,000 home. The lender does not care about your financial resilience. They care about the size of the asset they can securitize. This is why real estate agents and lenders work in sync. The agent wants the highest sale price. The lender wants the largest loan. Both get paid as a percentage of the transaction. Neither gets paid if you buy conservatively. The incentive structure pushes you toward the edge of your budget, and once you are there, you are locked. You cannot downsize without triggering transaction costs. You cannot move without resetting the interest clock. You are financially immobile. That immobility is the point. Stage 3 is where the promise turns into a trap. You realize the house is not passive. It demands constant input. The roof leaks, the furnace dies, the foundation cracks. Each repair is a referendum on whether you can afford to stay. And because you already stretched to buy, you have no buffer. So you finance the repairs, you open a home equity line of credit, you pull cash out of the structure you thought was building wealth. This is the hidden mechanic. The house becomes a loan vehicle. It is not an asset appreciating in value. It is collateral you borrow against to maintain the illusion of ownership. The more you borrow, the less equity you actually hold. But the system calls this financial flexibility. It is the opposite. It is debt expansion disguised as wealth access. Stage 3 also includes property tax escalation. Your local government reassesses your home's value periodically. When housing prices rise, your tax burden rises. But your income does not rise in sync. You are taxed on paper gains you have not realized. If you cannot pay, the state can seize the property. You do not own the house. You lease it from the government through taxation. This is why even homeowners who pay off their mortgages are never fully free. The annual tax bill is a permanent rent payment to the state. Stage 4 is where the system turns your pride into a liability. Homeownership is coded as success. Renting is coded as failure. This social pressure keeps you trapped even when the numbers scream to leave. You cannot downsize without admitting you overstretched. You cannot sell without admitting you were wrong. The identity you built around being a homeowner becomes a prison. And the system knows this. It counts on it. Social proof is the cheapest form of enforcement. If everyone around you believes homeownership equals stability, you will endure financial pain to maintain the appearance. You will pay more than the house is worth in maintenance. You will stay in a location that no longer serves you. You will sacrifice mobility, career opportunities, and liquidity to avoid the shame of renting again. Stage 5 is the math reveal. You are told your home appreciates in value. This is technically true. Housing prices generally rise over time, but appreciation is not profit. Profit is appreciation minus costs. The average home appreciates at roughly 3 to 4% annually. Subtract 1 to 4% for maintenance. Subtract 1 to 2% for property taxes. Subtract another 0.5% for insurance. Subtract 6% in transaction costs when you sell. The net return collapses. If you hold the property for 10 years, your real return after inflation and costs often sits near zero. If you had taken that down payment and monthly housing cost difference and invested it in a diversified index fund, you would have doubled or tripled your money over the same period. The system hides this math through emotional framing. You are told your home is your nest egg. You are told it is your retirement plan. You are told it is your children's inheritance. These statements rely on the assumption that the house will appreciate faster than costs accumulate. For most buyers, that assumption fails. The house breaks even at best. At worst, it becomes a money pit that consumes disposable income for decades. The opportunity cost is invisible until it is too late. Every dollar spent on the house is a dollar that did not compound elsewhere. Over 30 years, that difference is not marginal. It is generational. This is not a conspiracy. This is a business model. Banks profit from long-term debt. Governments profit from property taxation. Real estate agents profit from transaction volume. Contractors profit from maintenance dependency. Everyone in the chain extracts value from your belief that ownership equals wealth. The system does not need to lie. It just needs to withhold the alternative calculation. Here is where you are right now. If you already own a home and your monthly costs exceed 30% of your net income, you are over-leveraged. If your home equity represents more than 50% of your net worth, you are under-diversified. If you cannot afford to move without selling first, you are illiquid. If you are considering buying because you feel financial or social pressure, you are about to enter stage 1. The way out is not to panic. The way out is to stop treating the house as an investment and start treating it as a consumption choice. Run the numbers yourself. Take your expected monthly mortgage payment. Add property taxes, insurance, maintenance, and HOA fees. Multiply by 12. That is your annual housing cost. Now compare that to your current rent. Calculate the difference. If you invested that difference in the stock market every year for 30 years at a 7% return, what do you get? For most people, the answer is more wealth than the house will ever generate. This is not theoretical. This is compound interest math. The reason you were never shown this comparison is because the entire housing industry collapses if buyers start thinking in terms of opportunity cost. The second step is to decouple identity from ownership. Renting is not failure. Renting is paying for flexibility. Homeownership is not success. Homeownership is paying for stability. The question is whether you value flexibility or stability more right now. If your career requires mobility, renting is the rational choice. If your income is unpredictable, renting is the safer choice. If your local housing market is overpriced relative to rent, renting is the profitable choice. The system wants you to feel shame for renting because shame keeps you buying. Reject the shame. Make the choice based on math, not social pressure. The third rule is to never buy at maximum affordability. If a lender approves you for $500,000, buy at $300,000 or do not buy at all. The buffer is your freedom. It allows you to handle repairs without debt. It allows you to move without financial catastrophe. It allows you to weather income disruptions. Buying at maximum leverage is signing up for financial fragility. The house will break, your income will fluctuate, the market will shift. You need room to absorb those shocks. If you cannot afford a buffer, you cannot afford the house. The fourth rule is to treat the house as a consumption good, not an investment. If you love the location, if the space improves your life, if the stability benefits your family, then buy the house and accept the cost. But do not lie to yourself about building wealth. You are buying a lifestyle. That is fine. Just do not confuse lifestyle with financial strategy. The final rule is to exit if the math no longer works. If your housing costs exceed your income growth, sell. If your property taxes rise faster than your salary, sell. If maintenance costs spiral out of control, sell. Do not stay because you are emotionally attached to the structure. Do not stay because you fear what people will think. The house is not your identity. It is a box you live in. The moment it stops serving you financially, it becomes a trap. This is the lie you were sold. Buying a house will not make you rich. It will make you stationary. It will make you leveraged. It will make you dependent on a structure that extracts value every month for 30 years. The wealth you think you are building is being redirected into interest payments, tax bills, and maintenance costs. The equity you think you own is trapped in an illiquid asset you cannot access without triggering massive transaction fees. If this opened your eyes to the cage you are living in, subscribe, because in the next video, we dismantle the rest of the illusion.